people hear about the 1% start rates, and they think that's the greatest thing since sliced bread. Sometimes it's not, if you do not understand what that program is all about. Okay? The perception changed on that particular loan program too. That's called a negative amortization loan. Okay, and we're going to get into that a little bit here. Let's go to the side. Understanding the constant changing lending industry and not get burned. Okay, the first thing we want to know about. Fixed rate loans. Everyone understands in here what a fixed rate loan is. Okay? The major advantage of this type of loan is predictability. You know what your rate's going to be. The only thing that could change in a fixed rate loan is what? I mean, if you got a 30-year fix, there is one thing that could change in your monthly payment. Taxes. There you go. Property taxes. I got property, investment property, and I'm paying a lot more now. And I'm in a 30-year fix. I'm paying a lot more now than I was 10 years ago because my property taxes are going up. There's also 50-year loans that are in the market. 50, 40, 50. New products. 40's not as new, 50's brand new. So within the last year and a half, they just came out with that 50-year loan. There are lenders out there that will do that. New convertible arms. Most people do not know that if someone is living in a property and you want to purchase that property, you could do that and keep the same loan that the person has on that property. You don't have to go out and get your own mortgage. You can assume.
How can you assume somebody's going
Oh, did I? Right there. Sorry about that. I have certain terms and conditions. Say that again. You can take over that property just by qualifying under the bank to take over the exact same loan. It's called a single ability. Okay. There's also a conversion. Fannie Mae now has a new product where you can convert an arm into a 15-year loan with a $250 fee. Okay? Compared to refinancing at 3 to 6% sometimes for refinance. Adjustable rate mortgages. Okay, have become very popular. How many people here, by show of hands, are from California? Good number from California. Adjustable rate loans are extremely popular in California because of why? Why do you think they're so popular in California? It rises very, very good. And properties are very, very expensive, and it's risen over the past 30 years so quickly that it's blown most people out of the market. The home affordability index in the state of California is 14%. 14% of the people that work and live in the state of California can afford to purchase a house in the state of California. That's the median price house at $550,000. Okay? That's median for California. The area that I live in, San Jose, is $700,000. That's the median price house. Some of you people that are outside the state of California who are thinking these numbers are made up. They're not. These are actual numbers, and people that are from California, you understand those numbers. Okay, but only 14% of the people that work and live in California can afford to purchase a house. That's why adjustable rate mortgages are so popular. At least in California they are. In other parts of the country, not as much so. 30-year fix makes more sense. Okay? Easier to qualify for those types of loans. Popular indexes. Now, every loan that you do that's an adjustable rate mortgage is tied to an index and a margin. You add those two things together and you got your fully indexed rate. That's the rate that you're going to pay on that loan. The fully indexed rate, that's the rate that you should be paying. On negative amortization loans, sometimes you don't pay the fully indexed rate. We're going to talk about that, what happens there. Okay? LIBOR, very, very popular. Coffee, MTA, the bank prime rate, the Treasury T-bill, COSI. COSI meaning cost of savings index. CODI is a cost of deposit index. And then some other ones that are up there that are not as popular. The ones that are at the bottom are not quite as popular. You don't see that, but you do see them. There are 32 different indexes. 32. A lot. It's not your job as a consumer to understand what all of them are. It's the job of your broker to understand what they are. Okay?
How do they apply to us?
You need to know what those indexes are, because then you can track that index and you can track the historical the performance of that index by knowing what that particular index has done over the past 20 to 30 years. You can track it. You can go back and look at it in your local newspaper, the Wall Street Journal, bankrate.com. That's a good website to go to, bankrate.com, where you can track the indexes, track the historical performance of that index, whether it be the CODI, the COSI, the LIBOR, the cost of funds index.
Okay, I'm not a real estate person, so I'm going to ask this
So
question.
that index has been stable for the past years and really hasn't risen above 4%. You feel a lot more comfortable about getting into that particular index as opposed to an index that was up and down and went to 8% one time and went down to 4% and was all over the place. And if you knew you were in that particular index, you would say, hey, you know what? This is not a volatile index. This is a real comfortable index I can be in.
Stability.
Yeah, the stability of that index. Yeah, and that's as a consumer stuff you would want to know.
Thank you.
Those indexes are based on the cost of savings. All the people that have a savings account at this one particular institution, all the people that have the money there, if the savings accounts go down, well, that index rises because it's risky. If the savings accounts are higher, well, guess what? That index is lower. And so that index is based on all the savings. It could, no, it's a more steady one. Yeah. And if you get inflation and people are needing that money to take the money out, they can't save their money, well then that index goes up.
Are you saying the ones at the top or the ones that are more steady? Or
No, those are the more popular ones. Yeah. LIBOR, the 6-month LIBOR, the 1-year LIBOR, you can check all of those out on bankrate.com. You can get an understanding of exactly how volatile those indexes are. They'll give you a historical performance over the past 30 years.
So this would be important if you have an ARM, for example.
Absolutely.
But if you have
for
a
ARMs.
only for ARMs, because if you have a fixed rate, you
Yes.
don't care about this.
You don't care.
care at the time that you get the fix. And that's
Absolutely, absolutely. There you go. A certain rate, it cannot go above 2 points of whatever that rate is. That's the cap on that index. Yes, that's a lifetime cap. Not to be confused with a payment cap. A payment cap is strictly a lot different. A payment cap, and we'll talk about that. The payment cap is, usually they're tied to, they're tied with, a lot of times they're tied with all kinds of adjustable rate mortgages, but negative amortization type loans have a payment cap usually of 7.5% over from 1 year to the next. 7.5% is a protection for consumers because back in the 70s and back in the 40s and 50s and 60s, there were no protections for consumers on adjustable rate mortgages. There was no protections at all. People would get into an adjustable rate mortgage, that thing would shoot up to 14%. Well, guess what? If you were paying 6% before, your payment is now 14%. You couldn't afford it, and you had to foreclose on your property. They said we have to do something with this, and they built in these protections for the consumer. Okay, to protect the consumer. So, as an example here, you see the 7.5% the previous year. If your mortgage payment was $1,000, the highest it could be on that minimum payment you were making could be $1,075, and that's your protection. You know that, oh, wait a minute, next year I could be paying, $3,000. No, it's not. They can't happen. The highest it could be is $1,075 on the minimum payment. Go ahead.
The popular index that you mentioned, does every bank, so you're saying, you look it up and see what they're using as an index.
Right.
Does that mean different banks use different indexes?
Yes, absolutely.
So
And for different loan products, they use different indexes also.
Okay.
There could be one bank that uses a couple of different indexes, depending on what type of loan product you get.
So you do your due diligence and you look it up and you say, oh, this is the index that's pretty good.
Yes.
Then you could just shortcut it
You can, but if you're working with a bank as opposed to a
Mortgage broker.
yeah, then you're stuck with it, whatever that bank has.
Right, but what I'm saying is you can kind of get an idea that this mortgage broker is saying, well, I'm utilizing this bank.
Right.
And then you say, well, what
What's
index
the
are they
next
working?
thing? Yeah,
And
absolutely.
that would shortcut your
That will-
thinking and your
absolutely.
determination as
It
to
will
what.
shortcut that, absolutely. It's a smart thing to do. Okay? We talk about assumability, convertibility, converting the loan to another type of loan. It's converting from an adjustable rate mortgage to a fixed rate mortgage. Okay? Find out if your loan has convertibility. Find it out. Not all loans do. Assumability, most of them do. Where you can just move right into a property, take over the same loan that that lender has, or that borrower has, take over the same type of loan, and continue on. Release liability on what? Yeah, once someone assumes that loan, yeah, they're responsible for it. They're responsible 100% for it. If they assume that same loan
Because
product,
at one time, you assumed the mortgage, but they never said,
no, you don't want your name on it anymore. If I'm going to let you assume my mortgage, I no longer, I'm off of that loan. I sold it to you. Okay, go ahead.
But that's the problem with VA, VA assumable.
Mhm.
Kind of catalog this.
A veteran is always responsible for the mortgage. If it's assumed by another veteran, that the original veteran's rights will go back to the veteran. If a VA loan is assumed by a non-veteran, the original veteran loses his right for another loan
Right.
until that loan gets paid off.
Exactly.
That's the only exception I know
Yeah,
of.
yeah, other than that, yeah. But that's, we'll get into a little bit of VA loans. We're going to talk about that. We won't spend a great amount of time because in California, we don't do it. There's no VA loans in California, okay? Because of the home affordability thing. There's a cap on the amount of money that the Veterans Administration or Veteran Affairs will lend you. And that exceeds what the local limits are in
It's
California.
not 580.
Yeah. Okay. Types of mortgage loans. FHA. Okay. And it used to be real attractive for people to get the veterans loans back in the 80s and 70s and even early part of the 90s because of the main attractability of the veterans loan was zero down. You didn't have to put any money down to get into the property. Just move right in. No money down. Well, now that's pretty much everywhere. That's real common now with most banks or brokers or lenders that you go to. If they don't have a zero down, they're kind of outside the box. Okay. Fannie Mae and Freddie Mac. There's a conforming and a jumbo limit. That limit changes every year until what year? Until what year did it not change? This year, exactly. This is the first year since I've been in the industry that number right there did not change. January 1st is when that number changes, the jumbo limit, 417. Anything above that is considered a jumbo loan. Anything below that is conforming to Fannie Mae and Freddie Mac. Okay, conforming. All right? BC paper. What puts somebody into a category where they're considered BC, outside of FICO score? What's that? Oh, that's the kind of borrower that we're talking about, the individual borrower. BC means BC paper. There's A paper, there's Alt A, okay, there's B, and there's C, okay, and some people even have E, and E don't stand for excellent, by the way. Okay. Right, that's really getting down there. But basically it's BC. Anything that falls in that lower category, it's the C category. Bankruptcy, yes. So if they've had a recent bankruptcy, if you know a person that has had a bankruptcy within the past whatever months, is there any possible way they can get a loan? Now, yeah, you can. What about, there's different chapters of bankruptcy. There's 4 different chapters of bankruptcy. 7, 13, 11, and what's the other one? Yeah, 12. Very good. Somebody took my class. 12, chapter 12. And the chapter 12 bankruptcy it's a farm bankruptcy. There's a lot of orange crops right now that are going under because of the freezing. Those orange crops that are freezing over, well, they have to file chapter 12 because they're a farm. That's a particular type of bankruptcy that a lot of people don't know about. Everybody knows about 7, 11, and 13. Chapter 12 is only used by farmers. Okay. What's that? I don't know. Neg-Am loans. Back in the mid to late 90s, I used to sell these loans like crazy. I sell them to everyone that was friend and family and my borrowers, and I had no compunction about getting them into it because I understand it. And I explain the ramifications of exactly what this loan product's all about. Okay, it's not the be-all, end-all to everyone. Okay, it's not for everyone. The Neg-Am loan can be a negative. Okay, but back in the 90s, it was very difficult to sell this type of product. And I was like, wow, how come people don't want to get this loan? You know, it's pretty. It gives you options. Yeah, you get 4 different payment options, and you know, you can make a real low payment. You get a real low start rate. But lenders weren't selling it. There was only 3 lenders back then in the mid-90s that sold it, and borrowers weren't buying it. I don't want anything to do with that. Go ahead.